Want to own shares in a great business perfectly positioned for the future of our society? Does a market-beating yield and a double-digit dividend growth rate sound good to you? Like the idea of getting a high-quality dividend growth stock on sale after a 25% drop in its pricing? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a highly diversified major tech player. There's an old saying, goes something like this: it's tough to make predictions, especially about the future. Well, I think we can all agree that our society's future is going to become increasingly reliant on all aspects of technology. Think IoT, wireless, broadband, data centers, automation, etc. You name it, this company is probably in it. And that is why its revenue, profit, and dividend should continue to grow for many years to come. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Broadcom Inc., which appear to be trading at a significant discount today. Broadcom Inc., stock ticker AVGO, is a leading designer, developer, and supplier of analog and digital semiconductor devices. With a history dating back to 1961, Broadcom is now a $220 billion by market cap semiconductor behemoth that employs 20,000 people. The company reports revenue in two primary segments: semiconductor solutions, 74% of fiscal year 2021 sales, and infrastructure software, 26%. While Broadcom's roots can be traced back to semiconductors, the company has, over the years, broadened out into areas like software through strategic mergers and acquisitions. Broadcom's still pending $61 billion acquisition of VMware Inc., stock ticker VMW, a cloud computing company, is something that will further diversify Broadcom across various aspects of technology. Broadcom's current technology offerings can be found in the likes of smartphones, servers, set-top boxes, storage systems, and controllers. The company is exposed to exciting, high-growth areas like data centers, broadband, wireless connectivity, and automation. It's actually difficult to name a major theme in technology that Broadcom isn't exposed to. And I do hesitate to use the word theme here. After all, we're talking about real-life, large-scale changes in the way our society has worked and will work. This is about the past, present, and future of tech and life. That is what sets up Broadcom to continue growing its revenue, profit, and dividend for years into the future. To date, the company has increased its dividend for 13 consecutive years. The 10-year dividend growth rate is a jaw-dropping 40.2%. Now, more recent dividend raises have been in the low double-digit range. Still, that's fantastic growth, and you're pairing that with the stock's current market-beating yield of 3.2%. While this yield is only 10 basis points higher than its own 5-year average, it's rare to see a 3% plus yield with a dividend growth rate this high. With a payout ratio of 46.9% based on trailing 12 months adjusted earnings per share, this dividend looks secure and poised for continued outsized growth. I like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. This stock's yield is at the higher end of that range, while the dividend growth rate is much higher than what I typically look for. Phenomenal dividend metrics here. Looking at business growth, Broadcom advanced its revenue from $2.4 billion in fiscal year 2012 to $27.5 $1.5 billion in fiscal year 2021. That's a compound annual growth rate of 31.1%. Truly stunning top-line growth, but it's been far from totally organic. A lot of this growth has been the result of serial M&A activity. A string of large mergers and acquisitions built Broadcom into what it is. The $18.9 billion acquisition of CA Technologies in 2018 is a prime example. CA Technologies was, at the time, one of the largest independent software companies in the world. The aforementioned move on VMware is yet another example. Looking at bottom line growth on a per-share basis should give us a better sense of the company's true growth profile, as we'll be able to see if there's been growth accretion to earnings per share or not. Broadcom grew its earnings per share from $2.25 to $28.01 adjusted over this period, which is a compound annual growth rate of 32.3%. EPS growth has slightly exceeded revenue growth, indicating some modest level of accretive growth. To be fair, I did use adjusted earnings per share for fiscal year 2021. This is due to Broadcom's frequent and sizable discrepancies between GAAP earnings per share and non-GAAP earnings per share. I'm not always a big fan of using adjusted numbers, but Broadcom's free cash flow does line up a lot better with adjusted EPS than GAAP EPS. I view the adjusted earnings per share as being a much more accurate representation of this company's earnings power. Looking forward, CFRA is forecasting that Broadcom will compound its earnings per share at an annual rate of 17% over the next 3 years. This kind of bottom line growth, while strong, would mark a material step down in comparison to what Broadcom has produced over the last decade. However, I don't see this as unreasonable at all. If anything, it would be unreasonable to expect a company of this size to continue compounding its earnings per share at 30% plus annually indefinitely. That's simply not realistic. I actually see CFRA's forecast as something that shareholders or prospective investors ought to celebrate. A lot of companies out there would love to grow at 17% per year. Giving everyone more to celebrate here, CFRA states the following, and I quote, "We have high confidence in management execution and expect Broadcom to benefit from higher spending from cloud customers looking to upgrade their infrastructure and networks. We think visibility remains extremely high near term across all core markets," unquote. This lines up well with what Hock Tan, Broadcom's CEO, stated in the company's Q3 fiscal year 2022 earnings release, and I quote, "Broadcom's record third quarter results were driven by robust demand across cloud, service providers, and enterprise," unquote. Tan also added this, and again, and I quote, "We expect solid demand across our end markets to continue in the fourth quarter, reflecting continued investment by our customers of next generation technologies in data centers, broadband, and wireless," unquote. This Q3 report, by the way, showed 39.8% year-over-year adjusted EPS growth. Simply put, this high-speed locomotive of a business isn't stopping at all, even if it may slow a bit over the coming years. If we take CFRA's earnings per share growth forecast as our base case, that still positions Broadcom's dividend to grow at least at a high single-digit rate over the foreseeable future. And it's very possible, perhaps even likely, that low double-digit dividend raises keep coming for the next few years. Meantime, the stock also yields north of 3%. That's a very attractive setup in my view. Moving over to the balance sheet, Broadcom has a solid financial position. The long-term debt-to-equity ratio is 1.6, while the interest coverage ratio is slightly over 9. Broadcom's elevated debt load, a result of so much M&A activity, might be the only chink in this company's armor. However, Hock Tan has been wise with his M&A choices, which greatly reduces my concerns here. Profitability is extremely robust. Over the last 5 years, the firm has averaged annual net margin of 25% and annual return on equity of 24.5%. Broadcom is a terrific business. Its diversified exposure to almost every exciting high-growth area of technology bodes well for the firm and its shareholders. I must also add, Hock Tan has been a masterful manager. And the company does benefit from durable competitive advantages, including scale, established relationships, IP, entrenched infrastructure, and technological expertise. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Broadcom's elevated debt load will become more expensive with interest rates on the rise. Hock Tan has been an M&A wizard, but there's always the risk that a deal turns out to be a bad deal for shareholders. The company's highly successful M&A strategy could also become limited by Broadcom's size, as it takes ever larger deals to move the needle. Customer concentration is a risk, with approximately 20% of the company's revenue coming from Apple Inc., stock ticker AAPL. As diversified as Broadcom has become, about 1/4 of the business is exposed to smartphones. Demand for electronics is economically cyclical. Broadcom must constantly work to stay ahead of the tech curve in order to not fall behind competitors. These risks are worth seriously considering, but I also see the positive facets of the business as being far more considerable. And with the stock down 25% from its recent high, the attractive valuation is also considerable. The price earnings ratio is 14.6 based on trailing 12 months adjusted earnings per share. For a company growing this fast, that's an absurdly low earnings multiple. We're talking about a PEG ratio well below 1, even after factoring in a growth slowdown. For perspective, the stock's own 5-year average PE ratio is 40.3. That ratio is skewed by lumpy GAAP results, but I think the disconnect here is still clear, and the yield, as noted earlier, is slightly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate looks suspiciously low in comparison to Broadcom's demonstrated EPS and dividend growth rate over the last decade, but I think it's more important to point out that the last decade was a special one for this business. It's nearly impossible for it to be repeated, especially with M&A being such a focal point. Both the debt load and the size of the business work against Hock-Tan in this regard, and even a great manager can only do so much. Indeed, CFRA sees a pretty serious drop in bottom line growth ahead, and I concur. That said, we're still talking about a terrific business growing at a high rate. Broadcom could and likely will exceed this dividend growth rate over the next few years, but I expect a moderation over the longer term. The dividend discount model analysis gives me a fair value of $584.93. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Broadcom as a 4-star stock with a fair value estimate of $624. CFRE rates Broadcom as a 4-star buy with a 12-month target price of $580. Boy, I'm almost right there with CFRE in this one, but we're all pretty close. Averaging the three numbers out gives us a final valuation of $596.31, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Broadcom Inc. is a terrific business being run by one of the most skillful managers out there. The company is exposed to and diversified across almost every area of tech that society is becoming increasingly reliant on. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, almost 15 consecutive years of dividend increases, and the potential that shares are 17% undervalued, this looks like a fantastic idea in tech for long-term dividend growth investors. And now for a special news announcement. Lowe's Companies Inc., stock ticker LOW, just reported yet another great quarter. Their Q3 report beat on both the top line and bottom line. The company also raised guidance. This dividend aristocrat just keeps putting up the numbers. We highlighted Lowe's back in late May as an undervalued, high-quality dividend growth stock to consider. After this great report, we've got to cover this name again soon. Meanwhile, if you haven't yet put this world-class business in your portfolio, now might be a good time to think about doing so. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.